Welcome back to SNS, Sweden's leading independent research-based think tank. My name is Mia Horna-Ransien and I'm the CEO of SNS. The yearly SNS Tylösand Summit in August was cancelled due to the pandemic, but we are very happy to have you here on this online version of the summit. The overarching theme of the conference is climate change. And in a series of sessions, we have discussed issues such as the energy challenge, the cost of climate change policies, the role of international trade, leadership, and global cooperation. Today, in the last session, we will discuss the role that finance and the financial system can play in combating and addressing climate change. Just before we start, apart from being online this year, we also have another change, which is that after approval from our speakers, we have decided to record the session and to make it available online. And this means that Chatham House rules cannot be applied. We encourage you, as always, to participate with questions. You can do it in two ways, where you can do it in written through the Q&A function, and you can do it verbally in raise hand function. And of course, you can text questions already during the sessions. So, our keynote speaker today represents an institution that has been pioneering the work of climate change and financial markets. The Bank of England was the first regulator in the world to set up supervisor expectations for the firms they regulate to enhance their approach to manage climate-related risks. Sarah Breeden is the Executive Director for UK Deposit Takers Supervision at the Bank of England, where she has oversight over the central bank work on enhancing the financial system's resilience to climate change. She also chairs the Workstream on macro-financial issues within NGFS, which is the central banks and supervisory network for greening the financial system. A warm welcome to Sarah Breeden. The floor is yours.
Good afternoon, and thank you, Mia, for the invitation to talk today about what I consider to be the defining issue of our time, climate change. I realise that this may seem an odd claim for a central banker to make in the middle of a global pandemic that's already led to the largest fall in UK growth in over 300 years. But our economy and our financial system, with the right support, should eventually recover from COVID-19. In contrast, climate change left unchecked will lead to irreversible harm for generations to come. So that demands our continued attention, even as we deal with the current crisis. Climate change matters to all of us in this virtual room, whether business people, investors, consumers, academics, or policymakers. And today, I want to deliver a simple message that finance and the financial system should play a key role in addressing the climate change challenge. That's both as we green finance by transforming reporting and risk management so that every financial decision takes the risks from climate change into account, and as we finance green through innovation and investment choices, and so drive change and support an orderly transition to net zero in the real economy. I am pleased to say that momentum on this topic is growing, but there is much, much more for us all to do if we are to turn aspiration into action. Let me start with why climate change matters to finance, to business, and to me as a central banker and regulator. It is, of course, obvious that climate change matters for the environment and for our planet. But what's self-evident now, even if it wasn't 5 years ago, is that climate change creates financial risks that matter for individual firms, and depending on the speed at which they crystallize, perhaps even the stability of the financial system as a whole. As the red box on this slide highlights, these risks can arise from the physical risks of our planet getting hotter, whether those are acute weather events like floods and wildfires or longer-term climate trends like the rise in the sea level. And as the blue box shows, they can arise from transition risks, changes in government policy, technology, and consumer preference that move our emissions pathway towards one that's consistent with net zero. Now, these risks will affect the economy as a whole. They affect users as well as producers of energy. So transition risk is not just an issue for fossil fuel companies with unburnable carbon. It matters also for transportation, agriculture, real estate, industry, even sovereigns. These risks manifest as the credit market and operational risks we financial professionals know well, but they have distinctive characteristics that require a different approach if we are to manage them well. First, the risks are far-reaching in their breadth and in their magnitude. They'll affect all agents in the economy, all sectors, all geographies. Their impact will likely be correlated, irreversible, and non-linear. They will therefore occur on a much greater scale than other risks. Second, these risks are simultaneously uncertain and yet totally foreseeable. I can't tell you now exactly what combination of those physical and transition risks we are going to see, but I can say with absolute certainty that either we carry on our current emissions pathway and face physical risks, or we change our pathway and we face transition risks. We cannot let uncertainty about what will happen lead to inaction and inertia. And then third, and for me this is key, the size and the balance of those future risks are going to be determined by the actions we start to take now. That's because once it's clear that we want to reduce the physical risks from climate change, it will already be too late to do so. And similarly, the longer that meaningful adjustment is delayed, the more disruptive a transition we will see. So we all need to stretch our horizons and think not just about the consequences of our decisions over the next few years, but instead to look much further out, perhaps decades. I won't pretend this is going to be easy. The size of the challenge is enormous. To put it in perspective, the International Energy Agency estimates that as a consequence of global lockdown, global CO2 emissions are going to decline by 8% by the end of this year. And yet, if we are to have a 2/3 chance of meeting a rise in global temperatures of 1.5 degrees, we would need to reduce emissions by that same order of magnitude every year for the next decade. We can't afford to repeat the experience of the pandemic. We need to achieve net zero emissions in a different, orderly way. And that requires us to be strategic, not responsive, taking different decisions today well before the consequences of inaction become clear. Now, of course, that change needs to happen in the real economy. Consumers, governments, corporates need to act to reduce carbon emissions. But if the real economy doesn't make that change, if instead we head down a path of increasing climate instability or towards a disorderly transition, the financial sector will bear that risk. It is self-evident that the financial system cannot diversify its way out of this risk. The pandemic has reminded us that the interconnections between the real economy and the financial system run deep. And similarly, while individual investors can divest, the financial system as a whole cannot. Indeed, seemingly rational individual actions that delay the transition simply make our collective future problems much bigger. Given the scale of change required, we will not be able to divest our way to net zero. Rather, if financial risk is to be reduced, so the underlying climate risks in the real economy must be managed. As I said earlier, to do that, we need to green finance and to finance green. Let me take each in turn. To green finance, it's fundamental that we get two things right: reporting and risk management. I start with reporting and disclosure because we cannot manage, or for that matter, price or trade, what we cannot see. The Financial Stability Board's Task Force on Climate-Related Financial Disclosures, the TCFD, provides the go-to framework for companies to disclose climate-related information. The initiative has significant backing, with over 1,000 companies showing their support. But the quantity and quality of these disclosures is not yet good enough. Climate change is a risk we see looking forwards, not backwards. Companies with the same carbon footprint today could have very different strategies for the future. One might have a credible path to net zero and the other oblivious to the risks. And so disclosure has to move from the static to the strategic, using scenario analysis to help us better size the risks in different future climate pathways. That naturally raises the question as to whether disclosures should be mandatory so that problems can't be assumed away. And I was encouraged to see that the UK government has announced that the UK will make TCFD-aligned disclosures mandatory across the whole economy, financial institutions and corporates by 2025. This is a huge stride in the right direction towards delivering consistent, comparable and comprehensive decision-useful climate disclosures. And if done right, it will allow investors and businesses to better capture the financial impacts of their exposures to climate change and price climate-related risks more accurately. It's a vitally important step. In addition to better reporting, we need to transform risk management. And we at the Bank of England approach risk management in two ways: bottom up at the level of the firm and top down at the level of the system. As Mia said, in 2019, we established supervisory expectations for banks and insurers to manage climate-related financial risk. These expectations cover governance, risk management, scenario analysis and disclosure, and are designed to ensure that firms take a strategic and forward-looking approach embedded in business as usual risk management, but grounded in the long-term financial interests of the firm. We've seen progress, but some firms are still some way away from implementing integrated policies, key metrics, mitigation strategies, detailed monitoring and risk appetite statements. And so we have asked the firms we supervise to fully embed these expectations by the end of 2021. Recognizing that this is a shared and unprecedented challenge for which we don't yet have comprehensive how to do it manuals, we've established the Climate Financial Risk Forum, chaired by regulators, but working with industry to build expertise and share best practice. Earlier this summer, we published a guide designed to provide practical tools, knowledge, and case studies, which all firms can use to help develop their own approaches to risk management, scenario analysis, and disclosure. Now, what's good for the banks is good for others who face financial risk too, and it would be great to see all players in the economy consider how close their businesses are to strategic and comprehensive climate financial risk management. I encourage you all to have a look. In addition, we need to consider these risks at the level of the system, consistent with our objective to safeguard financial stability. And Governor Bailey announced that the bank's climate stress test exercise is going to be launched in June 2021 after a short pause caused by the disruption of COVID-19. This exercise, it will aim to do three things. First, to size climate risks by shining a light on risks that are currently opaque. Second, to highlight where the opportunities are to reduce that risk, and so to identify where financial firms and their customers' business models need to change. And third, to build firms' risk management capabilities and prompt engagement with their customers on climate risks. This will be our first stress test that includes climate as well as economic and financial outcomes. We need to use not one, but 3 scenarios to explore both physical and transition risks. And we need to look ahead decades, not our usual 3 to 5 years. All of that means this is not a straightforward ask. This next rather complex slide highlights how to translate those physical and transition risks that climate change creates into macroeconomic and financial risks. It highlights that the channels from climate to financial risk are numerous, with significant interdependencies. The data and the methodologies to translate climate outcomes into macroeconomic and financial risks are incomplete and inadequate. And of course, the future path of the climate risks themselves is subject to huge uncertainty. As central banks and supervisors, we're clear that these uncertainties and complexities cannot lead to inertia and inaction. And that is why the central banks and supervisors network for greening of the financial system, the NGFS that Mia mentioned earlier, has developed a set of publicly accessible reference scenarios that allow us and allow you to explore economic and financial risks under a range of different potential climate pathways. We'll be using these as our starting point for our stress test, and I invite you to do the same as you look at your businesses. What I've covered so far is how we green finance, but it doesn't stop there. If we're to manage the risks, we need to drive change in the real economy to stop carbon being emitted, to finance green. That starts with risk, but shifts to opportunity. Governor Bailey recently said that investments that look safe on a backward look may be existentially risky given climate risks. And investments that have looked speculative in the past could look much safer in the context of a transition to net zero. This could not be clearer. We need to redefine what it means to make investment decisions and ensure that we're rewarding the future instead of the past. In my view, there are 2 components which will help us get there. The first is the need for innovation in instruments and investment strategies that can support the transition to net zero. We must channel investment to assets that will reduce carbon emissions, meaning we cannot make decisions based solely on current carbon footprints. That is where forward-looking disclosure comes to the fore. There are a range of approaches designed to measure alignment with climate targets, the share of a portfolio with net zero targets, or a portfolio warming metric, for example. Indeed, the Bank of England's own TCFD report, which we published for the first time this year, used the degree warming metric to assess our own small but nonetheless important corporate bond portfolio. As the thermometer here shows on the right, we are clear that our corporate bond portfolio is some way off the Paris climate goal. And that rightly prompts us to question, what are we going to do about that? But in addition, we need also innovation to identify new and innovative financing solutions to channel investments to fund real-world transition challenges. The need to retrofit 30 million homes for net zero, for example. Our second theme is the need to establish the right mechanisms for identifying and rewarding those investments that are supporting the transition. Capital markets play a key role in establishing price incentives that reward investments aligned with the transition. And they can also create the opportunity to trade different views on the future price of carbon. But with the overwhelming amount of metrics and labels available, it can be a challenge for the credible to stand out. One could easily think of at least 10 different reporting metrics that make comparability a difficult task. Such labels are, however, key. Net zero is not about a handful of deep green assets. It's an economy-wide transition. We therefore need markers assigned to all investments that demonstrate a credible transition plan, backed by certification and standards that provide independent assurance. Just recently, the IFRS Foundation put out a consultation which seeks to establish a new global standard-setting body for sustainable reporting, which the bank fully supports. I'll provide a brief final thought on how climate policy and financial markets interact. As I said before, to manage this risk, we need change to happen in the real economy. And climate policy provides the backdrop for this by establishing targets, agreeing internationally consistent standards, and setting the bar for the pace, scale, and inventiveness required to reach those targets. Whether policy comes in the form of regulation, taxes, or emissions trading schemes, the private sector will need to adapt to deliver against these. And given the trajectory of public policy, with governments implementing or signalling their intent to implement, the financial system can pull forward that transition. Let me use shadow carbon prices to provide an example. In a Paris-aligned scenario, one of our NGFS reference scenarios suggests, as shown in the grey line here, that we would need a carbon price of around $100 per tonne by 2030. In a disorderly scenario, the green line shows it is much higher. You can begin to incorporate such shadow prices in your financial decisions now. And if you do not, we're on the pink line, a path to 3.5 degrees. Let me conclude. I've attempted to make the case today that climate change matters as a financial and macroeconomic risk, and that the financial sector has an important role to play in stewarding the economy on its transition to net zero. To do that, we need a resilient financial system that can see and manage the risk. And we need innovation in investment strategies and instruments to channel the funds that will close the gap. Fundamentally, we need bold businesses that will recognise the degree to which they can, indeed the degree to which they must, drive that transition to net zero. Now's the time for action, to set out credible plans to get to net zero, to be brave, and to take different decisions today, decades before the consequences of inaction are clear. And investors will look out for those that do it right. This is not an easy endeavour, but it must be done. And after all, it's better to be roughly right now, not precisely right when it's too late. Thank you.
Thank you, Sarah, for your very rich presentation with so many important thoughts and facts. I would now like to invite our two panelists into the picture and into our discussion. Welcome, Anna, and welcome, Magnus. Anna Breeden is the Deputy Governor of the Swedish Riksbank. She was previously the Group Chief Economist and Global Head of Macro Research at Swedbank. Magnus Billing is the CEO of Alecta and Chairman of Stockholm Sustainable Finance Center Advisory Board. You're also a former member of the European Commission high-level expert group on sustainable finance. And previously, you also served as the CEO of Nasdaq Stockholm and Nasdaq Nordics. So I would like to start to give the floor to Anna. Please, you have the floor.
Thank you, Mia, and thank you to SNS for inviting me. It's always a pleasure to be at Tylösand, also in this digital format. And thank you, Sarah, for your excellent comments. It's a true pleasure to listen to you. I wish everyone in the central bank community was quite as forceful and determined as you are. I would like to focus my short remarks on what central banks can do in terms of greening the financial system, but I focus a little bit more on the monetary policy side rather than the regulatory side. And I'd like to start by presenting the monetary policy decision that the Riksbank announced earlier today, but focusing only on the part of the decision related to sustainability and climate change. So today, the governing board announced 3 decisions related to sustainability and climate change. And please note that the governing board voted unanimously in favor of these decisions. So first, we decided to introduce norm-based negative screening in our corporate bond purchases, and that will start in January as of next year. And this means that we will only offer to buy bonds issued by companies deemed to comply with international standards and norms for sustainability. So the principles in the UN Global Compact are one example of such standards and norms. And let me just stress that, of course, success here would mean that we don't need to exclude anyone, any company, but the point is that we can. And this is sustainability, so it's somewhat broader than climate change, but climate change falls within this ESG rating that we will be looking into. Second, we decided to include green government bonds in our asset purchase program. Green government bonds didn't exist in Sweden when the asset purchase program started, but it does now, so we needed to make that decision formally. And we also decided to include green municipality bonds in the purchase programs. And just to not confuse you, green corporate bonds, which is quite a large share of new issuance in the Swedish corporate bond market, has been included since we started our program in September as of this year. And I would also like to point out that already ahead of today's decision, we have communicated that we will report and measure the carbon footprint related to our corporate bond purchase program. And there are 2 reasons for that. We want to be as transparent as possible about our portfolio, but we also would like to encourage and foster more firm level reporting on climate related risks. These are just some examples on how the Riksbank is working with climate change at this point. I also like to mention that, of course, what Sarah is talking about, and I think this is the most important that central banks can do, and that's the regulatory side. In Sweden, the FSA has responsible for financial regulation, but the Riksbank does participate in many international committees and organizations that are now currently, they have climate change very high on the agenda. The Financial Stability Board, the Basel Committee on Banking Supervision, of course, within the IMF and the NGFS. We also take sustainability perspective in the management of our foreign exchange reserves since the beginning of last year. And here we have actively done some reallocations across assets to reduce the carbon footprint of our foreign exchange reserves. And of course, to an increasing extent, we focus on research and analysis on how climate change affects our economies. And we aim to promote data collection and transparency. And it's just not stress testing, but it's also important to look into climate change into our other macroeconomic models, just our regular forecasting models. This is not standard today. So that's one area where we will increase our efforts and have started to increase our efforts lately. And finally, I would like to clarify a few points when it comes to central banks and the debate, what we can do in terms of fighting climate change. The first one is that the things that I mentioned today and the decision that we announced this morning, it falls very well within our legal mandate. I mean, we do not need to wait for any dual mandate. I'm not even certain that would be a good way to go. Within our existing mandate, we can actually start taking some action within the central bank community, of course, on the regulatory side, but also some steps in terms of what is more pure monetary policy operations. And let me explain how we can justify the negative screening in the corporate bond purchases. We are legally obliged to take a risk management perspective on all our asset purchases, on everything that is on our balance sheet. So from that perspective, it's clear that prudent risk management is actually to do some form of negative screening, in the same way that we only buy investment grade bonds, for example. So the legal mandate I don't see as a big challenge in terms of central bank action within this respect. Second, and I don't, it's pretty clear when you listen to Sarah that many people don't have that perspective. That could have been misunderstood. Let me change what I'm saying right now. I think Sarah would agree with me, but there's still some people that think the central banks are trying to step outside of their mandates, but also that we think that we can play an extremely decisive role. That's not the case, and I shouldn't need to point this out. The best policy tools rests within national governments in collaboration across the globe. Things like carbon pricing will be crucial if we're going to make any steps forward. But central banks can act as a complement to other policymakers. And I think it's both naive and dangerous to think the central banks should not do anything. And it's not just on the financial regulation. We have to look into the monetary policy side of central banking. And as you all are aware of, most of us are close to some sort of effective lower bound in terms of policy rates. And that means that what used to be considered unconventional monetary policy, such as large-scale asset purchases and targeted lending, such as TLTROs and funding for lending, that's conventional monetary policy today. And these policy measures they influence financial markets. And we have to at least make sure that we do not actively counteract any other policy measures taken by other policymakers to fight climate change. We should at least make sure that we don't do any harm. And my final point, and Sarah was also here talking about this, and that is that climate change affects central banks in the sense that it affects the whole economy. And it's a threat to financial stability, and it's also a threat to price stability. It will affect macroeconomic developments in every respect that we can imagine, in terms of productivity, in terms of growth, in terms of labor markets, in terms of inflation that I just mentioned. And it may even affect our ability to conduct monetary policy. So today we have a new research note out showing that climate change may contribute to even lower real interest rates, in particular in the absence of an orderly transition. And there are more details about this in our monetary policy report that we released today. Today we took a few small steps, some first steps related to sustainability and climate change related to our monetary policy operations. These are small steps, but it is a policy innovation, and I'm looking forward to hearing your thoughts about that and to participate in the discussion. Thank you.
Thank you very much, Anna, for your presentation and also for the issues you raised. And before I open up, I come back also to Sarah. It's time for Magnus. Let me also remind you in the audience that you are most welcome to put questions in the Q&A function or raise the hand function. So Magnus, the floor is yours.
Thank you very much, Mia, and thank you for having me here today. I'm very proud to be here and privileged. I would like to thank Sarah for a good presentation, very interesting. And Anna, I would disagree with you immediately. I don't think it's a small step today, and congratulations to that step. I think it's a big and very important step, and I think it's very interesting to see that you are arguing for that it falls within your mandate. I think that's a key argument, and so congratulations to that. I thought I'd talk a little bit about the asset owner perspective in this context, and basically 3 points. What are we trying to achieve as an asset owner, Alecta? Where are we today? And what are the challenges that we see in the short to mid-term time perspective? And we manage today about 100 billion euros, and we have a fairly straightforward portfolios with equities, fixed income, and real estate assets in there. We have committed that the portfolio in its entirety should be net zero by 2050. And that is part of the Asset Owner Alliance commitment that we have made, but it's even more importantly part of a clear fiduciary duty that I believe we have as an asset owner. And I think that is mainly the key driver for us to start to look more meaningfully towards allocating capital towards sustainable investments today, i.e. a clear message from our customers, the 2.6 million Swedish individuals and 35,000 Swedish enterprises, that their money should be managed in a sustainable way. So to me, it's part of the traditional fiduciary duty to ensure that we allocate this capital to more sustainable assets out there. What we have done then, based on this obligation that we have towards our customers, is to enter into the green bond market, of course. We have today about 50 billion euros in our green bond portfolio, which is significant also in a global context. We have started to enter into the impact investment world. It's a challenge to enter that because of issues with scale, standard and metrics that Sarah talked about. But it's a good way to enter into an area which is aligned with the SDGs, or the 17 SDGs that the European United Nations have adopted. What I think is interesting from Alecta perspective is what we have done the last couple of years, and that's stress testing our portfolio with a number of climate scenarios. We've been stress testing our portfolios for many, many years, obviously, as part of our regulatory obligations towards our supervisors. But in the last couple of years, we tried to introduce a number of climate scenarios and to see what kind of impact does these scenarios have on our valuation of our assets. And I'd like to say a few words about that, and that is then coming into the challenges that we have met when we're doing this. I will focus a little bit on equity side because I think that's the easy part to some extent, but it's also containing most of the challenges going forward. But we have done it on real estate, and on real estate, it's very much currently on a drive and strive to find energy efficiency to ensure a compliance with our obligation towards net zero. On the fixed income side, I think we have, in this stress testing we're doing, we don't see a significant impact on the valuation. And I think one key component there is the duration of the fixed income portfolio. So I think we need to develop a methodology where we can see beyond the duration of the specific instruments to find the true impact that these instruments have on our portfolio in this net zero environment. Now, on the equity side, what we've done there is basically simply doing a net present value calculation based on assumption of the carbon price. The methodology we used was to use the assessments that is found in the IPCC report and the International Energy Agency report. And then we applied the TCFD recommendations on scenario analysis based on that. So that is the two components of the methodology we've used. Now, when you look at the research on this topic and you try to find a carbon price that is taking us to a point where we have a net zero equity portfolio, it starts to get quite complex because you can find a spread between around $140 to all the way up to $250 per ton, depending on which research and what you believe of the necessity on the carbon price with regard to the net zero goal. But we took a price, we discounted that from 2040, and clearly we get another valuation of the assets compared to what the market is showing. I think that's the key takeaway from us in this exercise, to get that difference in valuation. it serves a very strong basis to engage with the corporates that we own shares in. You can then have a constructive, detailed discussion about questions like, you are not catering for all your cost in your business. What's your plan about that? Can you funnel it through to your customers? Is this a cost reduction case? Or do you have to adopt your business model in order to ensure that your business model is aligned with the Paris Agreement and net zero, which is our objective? And we will not be able to reach that objective unless you, dear corporate, is providing the input there. The impact that we saw on the equity portfolio is also very varying. If you just consider scope 1 and 2, when it comes to disclosure of emissions, the impact is not that significant. It ranged between 5 to 20%, depending upon which carbon price you decide to use. But if you include scope 3, which I think is very important if we're going to reach a true net zero position, the range is becoming significant, all the way up from 20 to 48% market value impact. Now, I don't think we can say, based on these outcomes, that we can act upon it in the way we normally act when we do investment decision-making processes. And the reasons for that is a number. I mentioned one, the carbon price spread, which is difficult to manage with that widespread. The other part is the reporting level on the issuer side. If we look at the investment universe that we assessed, and you look at scope 1 and 2, approximately 80 to 85% of the issuers are reporting. And that's a fairly good level, but obviously we need to get up to 100% there. Again, another topic for us to work with on the engagement side. But if you look at the scope 3, the reporting level decreases significantly, all the way down to around 55% of the issuers. Clearly, that's not an adequate level in order for you to make proper investment decisions with the objective to ensure net zero. On top of that, the third challenge that we meet is the quality of the data. I'm not saying that the poor quality of the data should sort of prevent us from taking actions. On the contrary, we should continue to take actions, but we have some work to do in order to ensure a better quality that could serve a better purpose in the investment decision-making process that we apply. To give you an example, in our case, when we stress test our portfolio, we sourced data from third-party suppliers, and we also sourced the data directly from the issuers, and we compare them. And we could find differences of 20 times emissions level on scope 3 reported scope 3 reported level. Now that is a challenge in itself. What even surprised me even more was that the issuer themselves were the one that were reporting more emissions compared to the third-party suppliers in the market space. So I think we have come fairly far, and I'm very glad to hear your talk about, you were talking, Sarah, about the work you're doing to promote best practices and methodology for stress testing the portfolios. I think that's a very important step for us as an asset owner to improve and learn from others. I'm also very encouraged to hear about the UK example to set a mandatory obligation on TSD reporting. I think that's an excellent way, and that will support us as an asset owner investor going forward. I would like to add one component which I think is very important in this, and that's related to the governmental subsidies towards fossil fuels. We are to some extent as an investor working against the wind here with some headwind, given the fact that approximately 5% of the global GDP is still the amount of subsidies going into global fossil fuel industry. Obviously, that distorts to some extent the market economics of investments when you assess the viability of an asset and the potential to yield return. Thank you very much.
Thank you, Magnus. I would really give you the chance, Sarah, to comment on the two, what you just heard from our two panelists, before I will put a question from the audience. Please, Sarah.
Thanks, and thanks to you, Anna, and you, Magnus, for your fabulous leadership on these topics. To hear how both of you are incorporating these issues in your everyday business today, taking different decisions, acting now is fabulous. I say that you are leading the way, and I hope many more will follow. I think there's an interesting debate to be had about negative screening versus engagement with corporates. I absolutely agree, Anna, that your aim is not to exclude any corporates, that your aim is to drive the right behavior. And I hear from you, Magnus, about engagement with the corporates that you invest in to try and drive those right behaviors. I think trying to get that balance right across carrot and stick, if I might call it that, is an interesting challenge for us all.
Thank you. Now I would like to put a question from Matthias Frumeri, who is the head of the Swedish delegation to UNFCCC. And his question is, first of all, he says, thank you very much for excellent presentations. And I think this actually picks up on the point just made here also by you, Magnus. What would you identify as the three main barriers to greening the financial system? And I think it probably, I would like to start with you, Sarah, and then if you other would like to add something, you're welcome. Sarah.
So to Anna's point, I think the first thing we need is a forward path from the regulators of the real economy about what is the intended climate policy. So far, what we have in general is a destination, net zero by 2050 in the UK case. But it's not enough for the financial system to know that we're going to be net zero by 2050. It needs to know how we're going to get there. That's about future carbon prices. It's about fossil fuel subsidies. It's about, I don't know, when electric cars are going to be the only kind of cars that are available for sale. So I think first and foremost, clarity on the path to net zero, as well as clarity on the outcome. That would be my first. The second barrier that I think there is speaks to some of the challenges that Magnus and Anna described around our data and methodologies, trying to understand how best to size climate risk, what future climate outcomes mean for economic and financial risk, developing data sources, developing analytics to help us support that. And then the third thing, and it's the holy grail, I think, is trying to develop a measure so that we know that we're doing enough. I get told all the time that, banks are investing hundreds of billions of euros or hundreds of billions of dollars into particular types of lending, that we have however many trillion of funds in ESG funds. How do we know that that is driving the investment and the transition in the real economy at the right pace? So that would be my third, a metric that tells us we're doing enough.
Thank you. I think I turn to the next question from the audience directly, and you may choose who want to raise your hand, who wants to take that. And that is from John Hassler, who is, among many things, professor of economics, but also was the chair of the SNS Economic Policy Council Report 2020, Swedish Policy for Global Climate. And he asks, stress testing requires quantitative assessments of the risks caused by climate change. The Riksbank recently did that for flooding risks. In a worst case scenario for the year 2100, and without precautionary adaptation, 5% of bank lending is at risk in an extreme weather event. Should this be considered a risk if a worrisome size for the financial system? That's the question. Anna.
I raised my physical hand because it's harder to reach it on the screen. Well, of course, you can discuss whether 5% is a big risk if it's a long horizon. And as we all know in Sweden, we're not one of the countries that will be the most affected by rising sea levels and flooding. I think it's just interesting to see that even Sweden cannot disregard that kind of risk. And I think the point is more that we need to start to do stress testing widely through all the different sectors. And I think that the work that Sarah has done in the working group 2 at NGFS is, leading the way to make us able to do that. So I think you should just see it as one example of many to come in the coming years. Thank you.
Thank you. I will come with another question. You touched on it, but this is from Jonas Nukander, who actually was also part of this group who wrote this report I just mentioned, a professor. How do you view active ownership versus leaving carbon-intensive companies? Magnus, shall I turn to you?
Well, yeah, for us, I think it's very important to acknowledge the transition. I think for us as an active owner, believing in fundamental analysis, we are strong believers that over time, the engagement and the discussions with the corporation is adding value to us. And I'd like to stress that for us, the integration of sustainability in our investment is a way to ensure over long term that we can deliver pensions, i.e. a high return. So it's not a conflict there we see. And I think that's then goes into the engagement supporting transition, but obviously that will come to an end at some point if we don't believe in the plan that the corporates are providing and we don't see the milestones being delivered upon. But the stress testing is one way for us to encourage and have that engagement, to talk seriously and in concrete terms about, describe to us the transition journey you're on to. And I believe that could add value again to our equity portfolio, because I'm not sure that we fully understand today what corporates will be the winner of tomorrow and who will be the losers. I think the EU taxonomy is starting to show signs that we will see corporates that we believe today not being truly green to actually tomorrow's green companies. And therefore, I'm a strong proponent of engagement and an active ownership structure.
Thank you, Magnus. Sarah, please.
I absolutely agree with Magnus on that. As I said in my remarks, these risks and these opportunities are things that we see looking forwards, and trying to differentiate between those that have a credible plan to get to net zero and those that do not is one of the key challenges that we face. So I'm hugely supportive of an engagement strategy, but I do absolutely agree that at some point you have to say enough is enough.
Thank you. I have a question here from Erik Thedéen, who you know very well, and he relate to the issue of TCFD, and he writes on an initiative from IFRS that I think you mentioned, and the 5 ESG standard setters working together with, it's a lot of organizations here, IOCCO, and he says he believes that could be a next big step to establish a comparable and reliable disclosure of ESG, not least climate. And hopefully this could lead to concrete results to be discussed at the COP26 next year. We are at the Swedish FSA are leading the task force regarding this within IOSCO, and UK FCA also have an active role. It would be very interesting to hear comments from the panelists, and I would just like to add, should disclosure be mandatory, as we learn here is going to be the case in UK in 2025? Who takes that question? We have just a few minutes left. Please, Sarah.
So why don't I be brief? I'm hugely supportive both of mandatory disclosure and of the work that the IFRS Foundation, along with the standard setting bodies and IOSCO are doing. I think those are the foundational pieces on which financial markets are able to do their job.
I could just add to that. I think the mandatory part is an important part to support this. One needs to be a little bit cautious on who should be applying that mandatory obligation. I think there are a lot of European SME companies that one should consider, the administrative burden for them. But I think you can get a lot of results by focusing, for example, on large cap companies, mid cap companies on the public markets. I hope maybe that there's possibility also to get, a commitment as being part of, as being a listed company that you undertake to disclose as being being listed on that market, basically. That's sort of a self-regulatory way to achieve basically the same thing. But we need to get more reporting and better quality. That's no question about it.
Might I add one quick thing on the point about the public markets? What I would hate to do is have mandatory disclosure drive carbon emissions into dark corners where we can't see them. So we must all be cognizant of that. But I absolutely agree that the proportionality point, to ask a hairdresser to disclose her carbon emissions consistent with TCFD may be a step too far.
So, with those words, I think we have touched upon a number of very important issues, and where there's a lot of things happening and a lot that has to be done also in the future. So I want to thank you, all three of you, for very rich contributions to the discussion and also in your work. So, and also thank you to the audience who participated with great questions. This was the final session of this year's Tylösand Summit. You will be able to see the recordings later on of all the sessions on our website. SNS will continue to follow and have the issue of climate change in research projects, in webinars and seminars, hopefully, and in roundtables. On December 8th, I want to take this opportunity. We arranged a webinar in cooperation with the International Monetary Fund, IMF, and IIES on climate change mitigation, based on the third and last chapter of this year's IMF World Economic Outlook that was recently published. You're most welcome, and you will be able to read about it on our webpage next week. And with that, I hope you have enjoyed being part of this rather different Tylösand Summit. And I really hope we soon will be able to meet in person again. So take care and thank you.